You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody. That music means it's time once again for the Advisor's Option, the program here on the Options Insider Radio Network, where we break down the amazing world of options, sometimes the intricate, sometimes the confusing world of options for you, the busy financial advisor or asset manager who's maybe interested in, or maybe you already have both feet in the options pool and you want to dive even deeper. Either way, we've got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're just joining us on the Advisor's Option program for the first time, first off, welcome. And then secondly, we got some great archives, great guests, great discussions, great educational topics. You name it, the works. The easiest place to find all that, of course, theoptionsinsider.com. It's right there on the right-hand side of the homepage. You'll see the Advisor's Option. Click on that, and you're off to the races. Of course, you can always find it via your platform of choice. iTunes, iOS, all the fun stuff out there, of course. You can always find it, iHeartRadio, Stitcher, TuneIn, even, of course, via our mobile app available for iOS, Android, and the beloved Fire OS. So no matter how you like to get your favorite podcast programs, we are there for you. And, of course, however you listen after the fact, via iOS, via the app, via some other crazy Serbian website that links to the podcast, however you get to it. We love to have you guys, and we love to have your questions. So send in your questions, your comments. We do love to hear from you guys at the end of the day. And joining me on the program today, we have a couple of returning vets and then one newcomer. Let's start off with the vets joining us from, I think they're both actually from scenic and sunny Puerto Rico today. We'll start off with the most frequent offender. He is Mr. Chris Hausman, the portfolio and chief technical strategist over there at Swan Global Investments. Chris, welcome back to the Advisor's Option program.
Hey, Mark, it's good to be back. Had a little break and excited to get going again.
It's nice about the rotating seat. You can take a break for a bit. You can come back in. I don't get that luxury, sure. I'm on them all. But you guys get to rotate, which is kind of nice. Freshen up for the next episode. All right, and also joining us, speaking of freshening up, he's freshened up and he's back. He is Aash, Vyas, the Director of Portfolio Strategy and Overlays over there at Swan Global Investments. Aash, welcome back to the program to you as well.
Thank you, Mark.
And I believe you're joining us from scenic and sunny Puerto Rico as well, correct?
That's right.
There you go. Double whammy of Puerto Rico. And last but not least, you may remember him from a couple of his appearances on the network, including very recently on the Volatility Views program, but he's making his first foray here onto the Advisors Option program. He is Ilya Feygin, the Managing Director and Senior Strategist over there at WallachBeth. Ilya, welcome to the Advisors Option program.
Thank you. Good to be here.
And Ilya, I know you're just on Vol Views, but obviously we have some different listeners to this program. So if you could very quickly do us a favor, for all those who missed that program or listened just to Advisors Option, give us a quick overview of your background in the derivatives markets and what it is you do over there at WallachBeth.
Well, my background was primarily in the proprietary trading space and portfolio management. Spent a fair number of years trading all sorts of equity derivative strategies at major investment banks in New York. Then as a portfolio manager at hedge funds, doing both options, other derivatives, and macro strategies, and then have focused also on general strategy and asset allocation. At WallachBeth, we're an institutional broker-dealer. We focus on helping clients with all aspects of strategy and execution. And many of our clients are financial advisors, RIAs, asset allocators, other large institutions who use options within an overall portfolio context.
So if you're confused about how to execute those options or maybe how to construct something, maybe you give Ilya and his team over there at WallachBeth a call. All right, with the team assembled, let's dive right on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. Like the man said, this is the portion of the program where we break down the latest developments in the world of options and trends and stories, the big breaking stories, the developing research and studies that may interest you, the busy financial advisor who's considering or perhaps using options. And the big developments in the asset manager and options world, certainly since our last episode, was the big risk management conference. If you're not familiar with this event, listeners, it's an annual. Actually, it's on multiple times a year now, depending on where you live in the globe. It's a European version. There's an Asian version. There is, of course, a once-a-year U.S. version as well, put on by the CBOE, the Chicago Board Options Exchange. And the goal of this event is really to get together a lot of the different leading minds and thought leaders and practitioners in the volatility trading space and really pick their brains and have them release their latest data and studies. But this applies to a broad group. It's not all VIX and VIX options and futures. There are a lot of other presentations there as well, talking about hedging broad portfolios and different approaches. Harvesting risk premium was a big topic of conversation this year. So it's a very interesting event. I encourage you, if you are active in this space and you are in the area where this conference goes on, it rotates between California and Florida. It probably is worth checking out in person. But luckily for you, we actually have two of the speakers from that event on the program today. So I thought we would start there with a nice recap of what they discussed at the Risk Management Conference, as well as some of their takeaways from the event. I think, Aash, we'll start with you. You obviously you gave one of my personal favorite presentations. Obviously, I didn't get a chance to sit in all of them. There were too many. There were multiple tracks going on, so you had to kind of sometimes pick your poison. But in that sense, yours was very interesting. I think you definitely got my award, at least, for some of the best slides of the presentation with your dubious correlation slides. But walk our listeners through what the focus of your talk was and what some of your key takeaways were, as well as where you got those great slides.
Sure. Thanks, Mark. Well, I actually thought Professor Thorpe's presentation was the best, but I do appreciate the fact that you liked mine.
I didn't say best presentation. I said best slide. So there is a difference. I liked his too. So there, I'm carving that pie very thin, but still we're carving it up.
Understood. But the basic thing we were trying to illustrate is, the trend tends to be towards big data and quantitative metrics as far as part of the investment process. And we think that's very important, But when you're looking at large, statistical data sets, it's very easy to misinterpret the data, not so much as a function of the data, but just simply because of the limitations of human nature. It can be very easy for us to infer a relationship that's not there, or to lose track of the big picture, or to not account for things like the power law, or basically ways that these statistics can give results that may or may not correlate to a quality investment process.
Yeah, you certainly did. You did a good job breaking down those correlations. I personally will never be able to look at I think it was margarine and the divorce rates in Maine the same way again. So you've implied some correlations in my head that none were before your presentation. So well done in that regard. And Ilya, same question for you. You obviously also spoke at the event. What was the focus of your presentation, and what were some interesting takeaways there?
Well, I tried to cover several topics. The first was betting strategies, expanding on the work of Thorpe and Kelly, how there are also misconceptions in terms of quantifying the risk-reward in trades, where the trap is that there's over-betting on strategies which seem to have a high win-loss ratio, without enough regard to the probability of those strategies succeeding, and, illustrated some of the failures and some of the problems with betting size, and then went into some of the issues with options pricing around events, as well as different option strategies that are working in this environment that could be effectively used. We went into all sorts of option spreads. We went into situations where it was good to sell a narrow spread or an ineffective spread to buy something that has a better payoff. We looked at ways that those who have long positions or desire long exposure can take it in more efficient ways into events. We then looked at applying some of these options concepts and probability concepts to overall portfolio management. We looked at one of the big crowded trades going into 2017, which was a bet on U.S. policy and long the U.S. dollar, which we thought was not a good risk-reward bet for 2017, but many took it implicitly in many different asset classes and were burned by it in the first quarter.
It was an overall interesting event, and thank you for that breakdown there, Ilya. Before we move on really quickly, because a lot of our listeners, I'm sure, couldn't make it to the event, and CBOE is really closely guarding around those presentations. They don't share all of them publicly. So I'm curious, you guys obviously attended the event. I was joking earlier, one of the more common refrains I heard this year was harvesting the risk premium. So there were a lot of premium selling strategies on display at the event this year, as there were last year as well. But I'm curious if you guys, from attending the event, from listening to the presentations, of course, from talking to your fellow speakers and attendees, were there any interesting takeaways you guys got from the event this year? Maybe some interesting developments, some studies. Maybe there's a new narrative developing in the volatility trading world outside of harvesting risk premium out there that people are starting to wake up to. What were your overall takeaways from the event? Maybe Aash, we'll start with you.
Well, there was a lot of great content there. A couple of things that I took away. One, that looking at currency skew prior to some of these events is a metric that seems to have worked as of late. Now, sometimes these things work, sometimes they don't, but it seems to have worked reasonably well as an indicator. And the second thing was that a lot of these pension plans, due to underfunding, are pretty much forced into equity, and an option overlay or some sort of hedge component there would be very beneficial to them. That was very insightful.
That's a kind of recurring theme for just about every RMC I've been to so far, which is still, how do we crack that enigma? How do we crack that puzzle, of getting more pension funds, like you said, Aash, many of whom are effectively long equity or very close to it. How can we get them to even, open the door to be accepting or willing of things like buying a put, or even in your case, doing an overlay or things like that? These are things that are clearly and demonstrably beneficial to them, yet we still have a lot of issues getting past the gatekeepers, which is why at this event they often have a lot of presentations from those gatekeepers, the consultants to the funds and the gatekeepers there who hopefully are helping to spearhead a lot of this. Because you're right, going forward, it would be nice to see a lot of these funds be able to at least have some sort of protective element to prevent them from riding the market up and then riding it right back down again, as unfortunately many of them clearly seem destined to do. Ilya, same question for you. Outside of your own presentation, what caught your eye and what was the more interesting development or developments you heard over there at the conference?
Yeah, certainly a lot of focus on harvesting risk premia. A lot of interest in continuing to be long risk equities and other risk assets, but perhaps in a tail hedged way. I think there was a lot of focus on products like the VIX. There was a focus I saw a lot of presentations on weekly options. There were some interesting slides. I kind of liked the presentation from Barclays. They pointed out some structural things in the options market, such as, they tried to quantify the impact of option flows on the underlying indices, as well as, the impact of, various other, types of vega exposure and how it affects the market. I thought that was a pretty good presentation.
Yeah, Manish from Barclays always does an interesting presentation. As I recall, his presentation had a lot of different elements, including maybe how we look at skew, maybe a little bit backwards, and how the immediate way to characterize skew is always to look at the puts and the premium to the puts. But obviously, there's a numerator in that equation too, and that is the calls. And sometimes the call selling or lack thereof is a huge driver of what we typically term as skew. I mean, it's not really viewed that way. So I thought that was an interesting, maybe alternative way to look at skew. So I know whenever I go to RMC, I always make sure I sit into Manish's because he's always got a few interesting nuggets. Listeners, I encourage you, if you are interested, first off, head on over to search for CBOE RMC, and if hopefully some of those presentations will be available online, including maybe Aash's and Ilya's, so you can check them out for yourself. And then also, if it's going to be in your neck of the woods next year, it might be worth checking out if you are interested in these types of things and such. Listening to the program like this, I'm assuming that you probably are. Let's keep rolling, though. A lot of things going on in the Buzz segment this episode, including a lot of talk. It seems like everyone's got correlation on the brain these days in many different respects. We'll get to all of those. Let's start off, though, the Janus Funds. They always put out their Wealth Advisors Guide, their 2017 version. Had a note specifically warning about the dangers of correlation, which I found pretty interesting. And this was kind of aimed at your general advisor, your general asset manager, who's out there thinking he's diversifying amongst a handful of broad equity funds. But when you add these two together, you find that the correlation is very close to the S&P 500. They said they analyzed more than 1,700 different asset allocations of financial advisors, and what they found were that many advisors' models that employed 2 or 3 large cap growth funds were highly correlated, not only to S&P, but also to each other. So not only are they correlated to the S&P, they have a lot of redundancy built into their portfolios. Of the 50 large cap growth funds, the analysis found that of the 50 large cap growth funds, the S&P, their overall correlation was about 0.94, so very close. Obviously, if 2 such funds were paired, which happens very often in a lot of these allocations, that correlation was 0.9, and if more than half of those pairings, the correlation was 0.95 or higher. So if you're thinking you're diversifying amongst some of these very similar funds, think again. You're actually just effectively doubling down or very close to it on the same thing. And so their focus with their research report this year was you really should, if you're out there trying to get diversification for your funds. If you're trying to replicate the S&P, that's fine. Maybe go into a broad S&P fund. Whereas if you're looking to do something a little bit different, maybe get a little bit more active, a little more low volatility type portfolio and go that route. I thought this was kind of interesting. We don't see it. They also mentioned the correlation to the alts fund, the AKA the alts ghetto, as I often refer to it on this program, where a lot of these options-related funds tend to be lumped these days. We've debated that before. I'm sure we'll get to that and debate that again. They say the correlation was much better there for the alts funds, was a negative 0.03 for a managed futures fund. Market neutral is also there. Long-short fund about 0.91 and 0.86 for total return funds. Obviously, alts covers a broad spectrum of strategies. They have different correlations depending on the strategy, but overall alts seem to be a little bit better, even though, again, it depends where you're looking, if you're looking for diversification. Maybe, Chris, we'll start with you. Kind of interesting to see a broad study like the Janus study here, which is aimed at kind of the broad advisor space, really doubling down on correlation. And I'm sure this is an issue that's near and dear to your heart, because this is something I'm sure when you guys are out there talking about Swan and presenting it, this is an issue that comes up a lot. At the end of the day, we've said this before, you can look at all the different correlations you want, but when you buy a put, exactly what you're getting. You have a delta, you have a gamma. It's very quantifiable. You know exactly what that negative correlation is going to be, or that inverse correlation, and you can count on that. It's reliable. So this must be an interesting development for you over there, Chris.
Yeah, it certainly is. I mean, in the hedged equity space, which is our expertise, correlation is very important in constructing portfolios to make sure that you're actually hedged, right? I mean, the old CAPM model in the 60-40 portfolio is taking all these different assets, throwing them together and saying, okay, you're diversified. And I think what everybody learned during the financial crisis, that these products mixed together did not provide any type of diversification. So what we do here is we truly have a negatively correlated asset in conjunction with our equity, providing our hedged equity, if you will. So, we're not going to run into these issues of, is asset A going to provide some diversification for asset B and C and so forth and so on. So, that's why we deal with the option markets, because it's really the only vehicle that we have found to provide true diversification when you really need it.
Ilya and Aash, any thoughts on this and just kind of the maybe misperceptions? Actually, this goes right to your presentation. You were just talking about before, Aash, about the misperceptions people have and mistaken correlations they sometimes assume out there, or perhaps in this case, don't assume, really. They don't understand the correlations for what they're dealing with. I'm sure this probably caught your attention as well, Aash.
Yes, I'd pretty much echo everything Chris would say. And I just remember back from my floor trading days, I think both of you were down there at one point too. I just remember hearing over and over again, correlation is the only thing that goes up in a bear market.
Yeah, it certainly is the case. Speaking of correlation, since we're on the kind of correlation tip, I think we'll keep rolling into this one, which is getting kind of also harkens back to our conversation about RMC, because this is actually a point that was brought up there as well. A lot of people have been wondering for some time, maybe not this week. We saw a little bit of a spike in the VIX this week, but overall, realized volatility and implied volatility have been very low of late, and so we've seen a lot of developments out there as a result. People writing into us, writing into this show, and others asking why is volatility so low. There's been a lot of different speculations as to the cause. It could be political, macroeconomic, and things. One of the ones that was brought up at RMC and was brought up again here in this article here, I think this was out of Bloomberg, but which is, again, getting back to our point earlier about correlation, is that correlation also a huge driver of volatility. When all these parts of the index are kind of moving in lockstep, we see a lot of volatility in the space. What we've seen recently, of course, is kind of the exact opposite, that the realized actual correlation out there among different sectors in the S&P 500 is very low. It's close to the lowest level we've seen on record. That's data coming out of Bloomberg. And so when we see that realized the actual correlation between the different sectors in the S&P 500, guess what happens? As a result, you net all that together, you have much lower realized and actual and also implied volatility in the marketplace as well. So this has been an interesting explanation as to why we're seeing such little realized volatility in the marketplace right now. Again, this past week notwithstanding, we saw a little bit of vol this week, a little bit of a spike, but otherwise it's been pretty much pretty quiet times from a volatility perspective. Ilya, you obviously spoke at the conference at RMC. You probably heard this presentation someone gave. I forget who exactly the presenter was, who spoke about realized correlation. And obviously now this has been a big topic in the media as well. Is this a question you're getting from a lot of your clients over there at WallachBeth? Are they coming to you saying, hey, why is realized or implied vol, why is it so low right now? And is this an answer you're putting to them, realized correlation? What are your thoughts of this as a potential driver of volatility?
Yeah, absolutely. That's certainly worth a few points. The fact that realized correlation has been very low, as well as, implied. And, this was a big theme for us last year, where, we identified correlation as being way too high heading into the U.S. election. I think 3-month implied correlation on the S&P was near the 60 area. And back then we said, look, it's things are guaranteed to disperse, after the election, where sectors are going to go even opposite ways. And that seemed too elevated. And our prediction was that it would never be normal. It would just go to extremes. If people had extreme fear of a correlated move going into the election, it would probably collapse to extremely low levels afterwards. And that's exactly what happened. And that's probably worth a few points in the VIX. And the other thing that I think is interesting is that there is this expectation that eventually U.S. policy will come through. And that's kind of limiting the declines in the market. And so we're not seeing really such systemic volatility. We're only seeing volatility really ahead of events, and or announcements from Washington. So I think that's kind of been a characteristic of this whole environment, which kind of keeps the VIX low until there is an event and people get scared of it, be it a Brexit or an election. Or some, big policy announcement. And, that's what we saw last week, is people were a little bit nervous going into the weekend. But there isn't much systematic volatility once those little event tidbits go away. There's really nothing to move it, and sectors are continuing to move opposite ways.
Hey, Ilya, this is Chris. I have a question for you. Over the last few years, we've pretty much been inundated with all these volatility products. Now that it kind of sounds that correlation is more in vogue, or people are paying more attention to it because it failed so miserably during the financial crisis, are there any direct investment vehicles or trading vehicles where you can trade correlation directly, kind of like a VIX future? Is there a correlation future out there that is possible to trade?
Well, there are correlation swaps. You can put on correlation swaps. They're not listed as far as I know, but they do exist in the OTC market. And you can certainly do the traditional dispersion trade, which has been very interesting from both sides in the past 2 years. It's gone to extremes. You can trade, for example, the vol of the major ETFs versus the S&P vol, and vice versa. And that's been an interesting trade. So you can put on both sides, delta neutral.
Yeah, so I'm sorry, I do remember the dispersion trade being very, very popular before the financial crisis, and then it kind of went away, and it looks like it's coming back. But it sounds like there's no plain vanilla exchange-listed correlation future or anything where an advisor or an investor who doesn't have access to the OTC markets can trade. Is that correct?
Not that I know of. And, there's no liquid product that I know of like that.
All right, Mark, you can drop your suggestions into the CBOE box now, and they can list 50 correlation products.
I was just going to say, they're always looking for the next flavor of VIX or the next type of OTC or structured product that they can replicate on the listed side. So I'd be surprised. I'll have to go dig in. I'm surprised. I'm just looking here. They do have implied correlation indexes, but I think these are effectively like a lot of CBOE products. I use product in air quotes because they're effectively indices that they disseminate for research value, but there's no actual tradable product on that. So they have, because I thought this sounded familiar, they have been down this road before, but it would be nice to see something out there that actually is trading. As they began disseminating just daily values for the S&P 500 implied correlation index back in 2009. So there's a couple of different tickers for a couple of different flavors out there. So that's an interesting starting point, at least. But you're right, an actual tradable product that is out there ready for the end user, or perhaps even an advisor or a retail trader to use. Not so much yet. More again, kind of in the research and for discussing at a conference like RMC versus actual tradable products. Aash, any thoughts on this? Obviously, correlation near and dear to your heart. Any thoughts on this lack of realized correlation, therefore, AKA lack of realized volatility out there in the marketplace?
Nothing to add other than what the other panelists have mentioned. I mean, I think Ilya nailed it. Like, there's uncertainty, but it seems to kind of be event driven more so than systematic, which correlates to low vols and low correlations for the time being.
Yeah, speaking of volatility, the advisors, a lot of different advisor surveys lighting it up. It is the start to a new year, so a lot of firms out there kicking it off, looking at the advisor audience, surveying them on a variety of different topics. They talked about studies and correlation earlier. Another firm, Atomics, decided to ask them about volatility, which is near and dear to our hearts. Two topics we love, advisors and volatility. And like a lot of people coming into this new year, advisors were expecting maybe a little bit something different than we're seeing play out in the marketplace right now. They expected, according to this study, this is the Eaton Vance Advisor Top of Mind Index survey done by a firm called Atomics. They said advisors termed or chose managing volatility as their top concern, rating 114.5 on this atomic scale, whatever that is. I'm not familiar with that scale. This is a quarterly survey. They do over 1,000 financial advisors. 65% of the advisors they surveyed indicated the new presidential administration going to be a major driver of volatility. Ironically, a lot of people expressed that same sentiment coming into this new year on our network across all of our programming: retail, futures, options, institutional volatility. Pretty much, one of our guests, I believe, on our volatility program, even made the nice quote, I thought, that Trump is not a single-digit VIX president. Of course, that's exactly what happened about a month after he came into office. VIX actually did touch single digits. So what we've expected and what we were fearing in terms of volatility versus what has actually materialized in the marketplace has been, so far at least, two very different things. And it seems like the same is true for these advisors. 63% of them also reported, to talk about the political risk, 63% of them reported discussing politics with their clients in the context of investment choices. It's always a dangerous road to go on. You don't know if you're going to get your client angry at the same time. 1/6 of advisors surveyed raised the topic of politics with almost all their clients. They're also watching the Fed decisions, obviously, as a big driver of volatility. Nearly half, 46% of the advisors thought the Fed, again, going to be a major driver of volatility in 2017. And they said despite this uptick in volatility, or at least this expected uptick in volatility, these advisors they surveyed, they have a positive attitude towards U.S. equities. Usually when you expect vol to go up, the implied correlation, again, getting back to correlation, the implied other side of that is you expect broad equities to decline. Yet 56% of these advisors were feeling bullish about the year ahead. You don't usually see those two things going hand in hand: increased volatility, at least expectations of increased volatility, and also an expectation for increased equity markets. That's interesting. And they found these advisors, 54% saying volatility should be both managed to avoid losses and harnessed to take advantage of opportunities, which I thought was kind of interesting. And obviously those opportunities, the way you can exploit volatility, that opens up the door to a legion of strategies, including many of which we've discussed utilizing options here on their program. What's interesting, though, as well, the advisors were very optimistic about volatility and the use cases for it. Clients, though, not so much, and maybe this is where some of the disconnect materializes in the space. They said only 32% of advisors said their clients agree with this approach, which is the approach that volatility should be managed to avoid losses and harness, take advantage of opportunities. Remember, 54% of advisors said that, but they said only 32% of the advisors said their clients would agree with that, which is, again, a big gulf. And 48% said their clients believe volatility only should be managed to avoid losses. Again, seeing volatility in that very negative context as opposed to potentially being an area of opportunity. They said 60% of the advisors reported that clients are motivated more by fear than greed, which again, stands to characterize their view of volatility. But this is still good news because that indicator has declined from a high of 82% in August, where they said 82% were driven by fear. So a lot of interesting data here to parse, including the fact that the advisors, at least the 1,000 or plus or so that they surveyed for this, seem a lot more open to the idea of volatility than maybe you would have assumed a couple of years ago, and it being an area of opportunity, but also maybe their clients are lagging behind that a little bit. Maybe Chris, we'll start with you because this is, again, right in your wheelhouse here. What do you think about these advisors? Maybe their somewhat paradoxical expectation for increased volatility, but also increased markets, as well as their seemingly being willing to trade and do more with volatility, which maybe opens the door to more option strategies, but also the fact that their clients are still maybe lagging behind a little bit.
Yeah, well, the survey is pretty interesting. It is good that advisors are opening up more towards volatility products, volatility strategies. I mean, there's plenty out there that they can do, so that's a good thing. So maybe, anything that increases volume, liquidity, open interest is always a good thing for all of us who are involved in this business. As far as what's going to happen to volatility down the road, I think, like Ilya said earlier, I mean, we're kind of prisoners to the Trump administration and what kind of legislation is going to be passed. It's easy to say that I anticipate volatility to increase from these levels because it does ebb and flow. And if I was a betting man, hey, I'd probably have to say the right thing. But I guess this is almost we're in known unknown territory with how much legislation is going to get passed because we just the healthcare bill did not get passed the other day, and who knows if Trump's legislation is going to be passed easier or harder. Are the Republicans splitting within themselves? So I think, I right now, I think the pattern will be the same. You're going to get these short bouts of volatility, which you look at just recently, it lasted 3/4 of a day, and then all of a sudden it's back to normal. So will we get some type of systematic volatility down the road? I'm not sure. I think it's more of a wait and see game. If Trump does not get anything passed legislatively, then yes, I think then volatility will probably go back up into its cycle and increase over the long term because people are going to be looking around and saying, hey, none of this, we just had this huge rally since he was elected, and none of these things are passing, which means we're going right back to where we were. So I think over the next few months, we're pretty much in a wait and see game.
Yeah, it is interesting. You're right. On one hand, realize volatility can't stay at 6 or around 6 forever. But on the flip side, when that change is going to happen, how quickly that will happen, that, of course, is where the rubber meets the road. Maybe people have gone broke expecting explosions in volatility when none materialized, and also vice versa. So the timing is a crucial portion of that. Ilya or Aash, same question for you guys. What are your thoughts? This is obviously a very, very comprehensive survey of volatility and advisors. Advisors obviously seemingly a little bit more open to the idea maybe of trading vol than they were in the past, not as scared of it. And that also, again, opens the door to a lot of potential options and derivative strategies, but also maybe the client's still stuck in the mud a little bit. Maybe Ilya, we'll start with you. What are your thoughts on this? And does this equate to what your experience is in the marketplace? Do you see advisors being a lot more open to the idea of volatility being an opportunity versus, like we said in the past, it being maybe a little bit more of a scare factor, a stumbling block for them?
Yeah, I think we're seeing both. Institutions, RIAs, advisors, they see the volatility product, derivative product, as a way to meet their needs. Whether it's a need for extra income through overriding or harvesting, VIX risk premium, or their need to protect the downside after a highly appreciated market. So that there's really nothing else that they can use. As the people from Swan said, there's really nothing that'll protect your downside. The over-reliance on diversification, and we've also done heavy analysis of the portfolios of endowments, pensions, and, advisor portfolios. They all, implicit in them, have very similar bets. So, they're long corporate bonds, they're long high yield, they're long private equity, they're long U.S. equities, and they're all betting that the credit system will continue to function, that there won't be any issues, everything will be refinanced, etc. And there are many, negative scenarios where all of their products lose. And the only way to protect from that overall systemic risk, is the option or volatility product. And I think from the client's point of view, they're really placing a huge premium on the predictability and kind of stability of the outcome. They don't want huge outliers, as we saw in the financial crisis. So they're favoring simpler, long-only strategies, with outcomes that they think are going to be more tame and more predictable. And in those mandates, they're obviously missing some opportunities. And the financial advisor or the a little more sophisticated institution is trying to fill in that gap, by increasingly using this product. And it's not just advisors, but we're also seeing interest in basic option strategies by pensions and other conservative investors more and more.
Well, it's good to hear that slowly but surely those walls are being broken down. Since we're in survey season, let's keep rolling with the surveys. This time, not just financial advisors and not just traders, but actually these are alternative fund managers out here, which again is where a lot of option strategies are lumped, rightly or perhaps wrongly, depending on your point of view. And they surveyed these alternative fund managers, 200 plus. They call them alternative investment decision makers at a conference here. I believe this was in the Caymans, so probably a lot of tax shelters involved in that conference. But according to the results of this study of these alternative fund managers, they also view Trump and his administration as the biggest potential global risk in 2017. That was according to nearly half, 44% of the participants in this study. That was followed by cybersecurity, 25%, which is interesting. A lot of the U.S.-based regulators like the CFTC have come out and said cybersecurity is the number one overall risk to financial markets. These participants clearly viewing Trump as a bigger risk, and it followed much lower by China at 14%, and then European elections 13%, and then Brexit, I'm assuming the lingering tail, the ongoing devil in the details of Brexit at 4%. So Trump clearly leading this list of risks here. 85% also looking at the alternative industry overall. 85% of them, probably not surprising given the fact that they are alt fund managers, said the alternative investment industry would grow and increase assets over the next 5 years, which is kind of in line with what we've seen for the most part. The last year or two have maybe been a little bit challenging in terms of overall returns, but net assets have still been on the increase, over the past 5 or so years. 46% also predicted the number of funds would shrink over that period, which is kind of interesting, maybe separating out some of the wheat from the chaff. Again, that alts bucket includes a lot of things. Some of these are not like the other, and maybe some of those sounds like will be shaken out. 39% said there would be more funds. So a little bit of a close schism there. 46% saying fewer funds, 39% saying more funds. So I guess kind of pick your poison there. Overall, only 8% believed overall industry assets and funds would dwindle. And then 40% of these fund managers, they said were bullish about the opportunity for 2017. Actually, they're looking at some very specific sectors, real estate and real assets, whereas only 28% were upbeat about commodities. 18%, only 18% upbeat about equities, which is a sharp contrast to the broad survey of advisors we just talked about, and 14% about credit. So interesting stuff. A lot of different viewpoints coming to the fore and being analyzed and quantified here at the start of the year. Maybe, Aash, we'll start with you on this one. What are your thoughts here on the alt fund managers now? They're getting their say here, and them thinking kind of in line with a lot of other people that maybe the political risks, a.k.a. domestic, a.k.a. Trump, are the biggest driving risk factor here for 2017.
Well, I'd agree with Chris that I think that's a huge driving factor. I mean, on the one hand, Trump's policies over the long run historically are probably pro-business and pro-market, but as Chris pointed out, can he actually execute them and bring them into the realm of policy? I mean, this Obamacare defeat doesn't lend much confidence to that. But one thing I'd say, based on the probabilities in the list here, I think I would rank the European elections a bit higher, because you're looking at something on the horizon that's going to be here pretty soon, and it's a fairly large, discrete event with huge potential ramifications for the EU and the euro.
Yeah, I tend to agree. It doesn't say here when this was a conference where they surveyed people. I think this conference might have been in like late January, early February, so maybe that was still viewed as being on the distant horizon. Of course, this stuff takes the time to compile and get these results. So maybe it was not as immediate or imminent as perhaps we would probably see it now here getting into the end of March into April. Chris, same question for you. What are your thoughts here on this survey, this time of alt fund managers?
Yeah, well, I think selecting Trump as the biggest global risk is the easy answer. It's the most obvious answer. And I've been in this business as well as everybody else on this call right now, where everyone is saying yes, you probably should put a little something in the no category. I think the next big shoe to drop is going to be some unknown. I hate to use that phrase, but it's going to be something that catches everybody off guard. Every time everyone's prepared for an event, you know what? You get a little market dip, everyone monetizes, and it's all over. So I'm going to go out on a limb and say it'll obviously be something that nobody else is expecting. Too many eyes, too many people paying attention to Trump, and I don't think the next shoe to drop will come from there.
You know, we're already kind of seeing some of that. Everyone and their mother expected a lot more turbulence, a lot more volatility as a result of Trump. And so far, we've seen exactly the opposite. So you're right. Sometimes it's what we least expect that comes to pass in the marketplace. Let's wrap things up in the buzz here with, of course, everyone's most exciting, most interesting topic, which is tax reform. But when it comes, unfortunately, to options, you kind of can't talk options without the other side of the fence, which is regulatory, and that's what we're seeing right now when it comes to the regulatory treatment and tax treatment of options. Our friends over there at OCC and our friend Eric from the OIC, the Options Industry Council, could not be here today. He's traveling yet again, but they put out an interesting article kind of outlining what they term to be the big threats coming up from a tax treatment of options in the coming year. We know for this audience in particular, the advisors' tax being a huge driver for a lot of their investment decisions. And their CEO over there, OCC, Craig Donahue, outlined 3 potential areas that they see a lot of risks in the coming year in terms of treatment for options. Let's start with these bunch of different proposals. I won't bore you with who's proposing them or what status they stand in terms of different committees in the House or the Senate. We won't get into that. I'll allow you to dig into that if you like. You can check out the OCC's blog for more details on that. But effectively, there's proposals they're outlining have a number of perhaps troubling side effects. Let's start with one proposal that would treat all listed equity options as sold at the end of the year. Regardless of, I guess that just closes out the books for the end of the year, and we start fresh again in 2017. In the subsequent year, 2018. So I don't know how that would work for if you guys at Swan trade a lot of leaps. I don't know how that would work for a leap as it closed out and then reopened. A lot of that sounds like that's something that someone that clearly is not familiar with how listed options products work to put in a proposal like that. They also have another proposal over there on the Hill to treat appreciated stock as sold if a taxpayer enters into an option to manage risk associated with owning the stock. So, for example, if you're long stock for a client and you buy puts to hedge that stock, you have now effectively sold that from a tax purposes, which we all know is one of the primary reasons people buy puts to begin with, as opposed to selling the stock because they can't sell the underlying for a variety of tax reasons. So they tend to hedge with options. If you put this tax treatment on, that would eliminate one of the clear driving use cases for options, particularly for a lot of advisors out there who have clients with concentrated equity positions. And also, we have the tax treatment of options positions and how they're effectively how these outstanding positions would be taxed. But effectively, the big two are having options be marked as sold at the end of every year, and also if you buy a put against stock, for example, or sell a covered call against stock. This description doesn't really delineate between the two. That would effectively count as selling your stock, which we all know would have a huge chilling effect on the use case for options, particularly, again, as it pertains to this audience. Maybe, Ilya, and we'll start with you. I know you're not lobbying Congress, you're not a tax attorney, anything along those lines, but are you hearing any concerns from a lot of the advisors and clients that you interact with that these proposals are in the works and it may have a chilling effect on their business? Or maybe perhaps are you concerned about these and the impact it might have on your business? Or do you think this is kind of just more noise over there on the Hill and it'll work itself out eventually?
We haven't really heard too much in this aspect. I mean, a lot of the people we deal with, basically professional users of options, so they do take short-term gains, when they write premium, for example, every month. So this wouldn't really affect them too much. This would primarily affect people who are using options to hedge single stock positions, so individuals, for example, with large stakes in a company, that sort of thing. I would point out that, futures have the same treatment, right? They get mark to market as those sold at the end of the year. And futures are as popular as ever. In fact, there's pressure to move more and more into futures on the institutional side. Banks are currently under pressure because of the new capital requirements to move more of the non-cleared stock loan and swap product into futures, and we've seen an uptick in our single stock futures business, as well as the index futures business and things like the Eurex and the MSCI Asia, and we've seen a lot of interest in that, and we think there's going to be good growth in that area. I don't think these tax proposals are going to bury the entire options market. Obviously, a transaction tax would be very negative on any derivative product, but it doesn't seem that that's likely in the near term. It seems that all these things are addressed at trying to prevent people from not paying capital gains on appreciated stock, because there's pressure on Congress to be budget neutral. So that seems to be an area where they want to raise some tax revenue. Are people carrying stock, for many years and not paying capital gains?
I like your optimism there, Ilya, and you're not too concerned. And you're right, they don't have a transaction tax on this list, which has been kind of the looming bugbear in past years. So at least it seems like we're over that hurdle, which you're right would pretty much put the death knell on a lot of all transactions across the board, not just listed options. So it's nice to see that at least has gone away, and we hope that some of these more, shall we say, arcane ways to deal with options will be remedied in the near future. All right, that's it for the buzz. I want to make sure we get some of your questions on. So without further ado, let's check in with our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. Like the man said, this is the portion of the show where we answer your questions. We get a lot of them across all different aspects of the space. Let's start with this one. Kind of pertains to what we were talking about a lot throughout the show here. This comes from Steve. Very creative handle, just Steve. I like it. He says, with the VIX so low, I'm not selling a lot of options anymore because I'm afraid that I won't collect enough premium. Am I thinking of this incorrectly? Well, all sorts of interesting grammatical things going on in that question. But effectively, he's breaking it down. VIX is low. He's scared to sell options because he doesn't think he's getting enough juice for his trades. Chris, this is right up your wheelhouse. Maybe we'll start with you. This is obviously a question that's near and dear to your heart as well, because you spend a lot of your days not just obviously hedging and rolling the puts, but also, of course, looking for the short aspects of the DRS, so selling the covered call, selling the put leg against it. What are your thoughts here for our friend Steve?
Yeah, well, a low VIX environment is it can be a conundrum for premium harvesting strategies. But the most important thing about selling premium is really what happens to the underlying or realized volatility during the life of that strategy. So yeah, I agree with Steve. You're probably not getting as much juice in higher absolute volatility environments, but there are a couple of things that you can do, and I think he's doing one of them already. You can scale back on how much you're selling, right, and kind of keep some powder dry, so when you do have the pops in volatility, and then you can lay into it. Another thing you can do also is you can potentially construct an option strategy that has short deltas or has a directional view to the downside, because what happens to volatility when markets sell off. It increases. So you're already kind of leaning towards that way, right? So you can keep some powder dry, trade smaller units, and maybe have a slight tilt that's bearish to compensate for any volatility pops that you may get while you have a current position on.
Ilya, same question for you. You're obviously dealing with this as well. You probably have a lot of clients coming to you saying, hey, what do I do now? VIX is quite low. How do I harvest the risk premium to borrow a term from RMC? So maybe this is good times for you. This is people are seeking out your expertise even more. What do you have to say for our friend here, Steve, who is in the concern category?
Well, he's correct. When short-dated implied volatility is so low, you're not going to get a lot of premium for selling, 1 month out of the money option. But that doesn't mean that you necessarily should be always a buyer of options. There are many strategies right now which involve the sale of short-dated options, which have made sense. So one strategy that we've used effectively is the ratio spread. The 1/2 call spread, the 1/2 put spread. That's worked fairly well. It's created a fairly wide area of payoff where you're okay. And when you keep it short dated, yes, you don't collect too much premium for selling the 2-leg, but the underlying market also doesn't move very much. It hasn't really moved more than 5, 6, 7%. And those strategies have tended to be pretty good. And you can buy some extra premium at the money, to compensate for the fact that, you have a pretty bad payoff if things move a lot. So, ratio spreads have still made sense. You just got to move them a little bit out of the money and make them a little bit wider, just in case things move a little more. Time spreads have made sense in this environment. A lot of times we've found opportunities to buy a back option, which includes an event, and sell a front option that doesn't. And sometimes we've paid a little bit more implied vol for the back option, but it's been worth it because, when the implied vol is so low, to pay up half a vol or 1 vol, for a calendar spread is not unreasonable if the back option includes an event and the front doesn't. And there have been instances where you've had, run-ups in ETFs or stocks and you want to monetize it. We've had recommendations to sell stock, sell put, and maybe buy out of the money call, where if the stock goes back down, you'll get assigned at a lower level. And if nothing happens, you'll net collect premium because of the skew. So there's still strategies where you're a net seller of premium, even though premium is low.
I like it, Ilya, getting into the myriad ways. We're always big fans of ratios here on the network, as long as, again, they're done in a responsible fashion. I think you outlined a few ways to do just that. All right, we got time for one more here. Let's go with this one. This comes from Avec11. He or perhaps she asking, according to Financial Planning Magazine, more than a third of the nation's largest RIAs lost AUM, so lost assets under management, in the past year. What's going on? Does this reflect the trend toward passive investing and away from active management? You'd think a bull market period like 2016 would result in more AUM for advisors, not less. Do you think using options could have stemmed the tide? Interesting, a very savvy question here from Avec11. Obviously, probably an advisor themselves, or at least very well versed in the space. Let's start with you, Aash. What do you have to say here for our friend Avec11? Concerned about RIAs losing AUM in this passive versus active world?
Well, I think it's a great question. I think a trend is longer than a few years. And, I think it's a matter of personal preference in terms of active versus passive. You can win with both, depending on where you fall on the risk tolerance spectrum or where your clients fall on the spectrum. But I think the one thing to keep in mind is bigger picture. Look at a full market cycle, and neither active nor passive addresses systematic risk. And we know diversification can't address that either. So I think you can win with either, but you do have to account for systematic risk.
All right, and you're our guest, Ilya, so you get the last word here on this question. What do you have to say for our listener here who's concerned about RIAs losing AUM over and the overall trend toward passive investing and away from active management? And what role do you think options could have played in perhaps stemming that tide?
Yeah, I think you still have to look at, as Aash said, systemic risk. And you still have to be active. We run a large ETF business, which you would consider passive, but effective management even of ETFs, there's still active. There's still active decisions that you need to make, in order to maximize your return. And certainly, the fact that people can hedge with options and limit their risk probably is a plus, because clients are seeking more predictable and outcomes and less variability of returns. So it's an added kind of plus, to put money with someone who's knowledgeable and manages this well.
All right, everybody. That music means we've come to the end of yet another fun episode of the Advisor's Option. Of course, before we go, let me check back in very quickly. By the way, we love your questions. We didn't get a chance, obviously, to get to all of them, but keep sending those in. We read them all, even if you don't get a chance to answer them on the air. So reach out to us at Options on Twitter, or Stock Twits to the Options Insider on Facebook, or just go to theoptionsinsider.com, use our website feedback form there, or just use the old-fashioned way, questions at theoptionsinsider.com. If you're listening to this via our app, all those contact means are baked into the app as well. Just hit the button and you can reach out to us with your questions and your comments. We do love hearing from you guys. And before we go, one last time, let's go around the horn and check in with my cohorts, see what they're working on that may interest you. Ilya, you're our guest, so you get pride of place. If listeners are interested in what you're talking about today, they want to learn more about WallachBeth and maybe reach out to you guys, where should they go? What should they do?
Well, our website is a good place to start, WallachBeth.com. And my email is ifeygin, IFEYGIN, at WallachBeth.com. And feel free to, email any questions or inquiries.
There you go. Email the man directly, and he'll walk you through his multi-step process for putting on ratio spreads. And you, too, can harvest the risk premium even in this low volatility environment. All right. And you guys over at Swan are always working on a lot of interesting things, including your 10th box events, which you can learn more about at 10thbox.com. And I do believe you have a big event coming up in our neck of the woods here in Chicago. Not too long, I believe, in a couple of weeks. So why don't you give us a breakdown of what you guys are doing and what our listeners can expect if they're in the Chicago area or going to be here soon. What should they look forward to?
Yeah, so just a couple of other things before that. Our Director of Research, Michael Wayfield, came out with a new piece called Options-Based Strategies as an Asset Class. Our Director of Investment Solutions, Mark Odo, who's been a guest on this show as well, he came out with a really good piece called Passive Aggressive, Measuring Risks of Passive Investing Using the Pain Index. And as you mentioned, Mark, we're going to have our big CIO Summit up in Chicago. That's April 3rd and 4th at the Kimpton Gray. We're still doing our 10th box regional seminars, and the next two coming up, we've got April 26th in Troy, Michigan, one the following day in Tampa, Florida, and you can get more information about those at 10thbox.com.
There you go, 10thbox.com. That's the number 10, so 10, and then TH, and then box.com. And on behalf of Chris and Aash and Ilya, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in those great questions. Keep them coming, and we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.